morning, we took some time to frame the realities of the work that's going on the ground for agriculture, for producers, for the supply chain, for emerging brands and mature brands. Now we're going to pivot to take a closer look at how capital is playing a role. This next session, Investing in Regeneration from Soil to Stomach, will introduce you to 3 different funders who are approaching the investment in the space from different points in the value chain and through different asset classes. Here to moderate the discussion is Hayley Mull, an investment professional with experience in food and agricultural consulting, and it spans both from impact-focused advisory to operating family farms in both South Africa and the UK, so she sees the big picture. Hayley, I will add, just finished a very comprehensive report with Tom Slattery. Tom, where are you? I know you're talking somewhere. You're not here. Okay. Hayley and Tom just finished a very cool report for the Esme Fairbairn Foundation, and it was all about sustainable investing in food and agriculture. If you haven't checked it out, please do. And now I'd just like to pass it over to Hayley. Welcome, Hayley, Alessia, Johanna, and Ben.
One person.
Joanna's still getting her mic on, so she's coming. But to make sure that all of you are listening and not on your phones, I have some questions for you before we start. So hands up in the room if you just had a cup of coffee or had a cup of coffee this morning. Okay, quite a few people. Hands up in the room if you are from Brazil, Colombia, Indonesia, Cambodia, any of these countries. Brazilians in the room? There's a couple. Okay, so fun fact, Europe, the top 10 countries that consume coffee per capita in the world are all in Europe, and Belgium is about number 6. So thank you to the Brazilians in the room who are providing coffee for all of us to be listening during this session. So we're here to talk about investing from soil to stomach. I have this all-star team with me on stage. And the questions for all of you are not yet done. So we're going to be looking across the spectrum of asset classes and think about how we approach different points of intersection with agri-food from an investment perspective. So more hands up in the room. If you are focused, mostly day-to-day, on venture capital in the agri-food space, hands up, please. I see a few. I see Pelican Ag. I see First 30. There's a few. Right. Hands up in the room if you're mostly focused on private debt or private credit. So transition finance, farmer lending. Not so many, but there's still a few. And finally, if you're focused on real assets, so investing in actual farmland. Also quite a few, definitely a predominance of venture in the room. Well, I hope the goal for this session is for all of you to learn about what you don't know about and also maybe find some room for gaps, creativity within the spaces that you do know about. So thanks, Sarah, for introducing me. I'm here because I was lucky enough to work on a very cool report last year focusing on all these asset classes with the Esme Fairbairn Foundation. But to quote Winston Churchill, the report was, I think, at risk of not being read because it was so long. So thank you all to those of you who did read it. But what we got to do through doing that was talk to lots of people like these wonderful people on stage about their different approaches and try and find pathways through that. So that's what we're going to do on stage today. I'm not going to introduce everybody on stage because what they're doing is part of their introduction. But we do have a slide, magic slide, that helps you understand that across the value chain, different types of capital intersect at different places. These are by no means boxes. They're just examples of where that tends to happen. And so each of the people on stage are representing a different asset class. And so I'm going to hand over firstly to Ben to kick off his introduction. And Ben is our venture growth equity guy on stage. So go for it, venture guy.
Good afternoon. My name's Ben Newton. I lead Yo Ventures, a venture capital fund manager that has a very singular, simple mission, really, which is to drive the transition to a natural and healthy food system that regenerates both our human health and planetary health. So we seek out and invest in and support very closely those high-growth, high-impact founders and management teams that are really trying to disrupt the kind of incumbent food system in some way. We're based out of Somerset in the UK. So kind of an early start yesterday, and fantastic to meet old friends and new faces today and tomorrow. Please come and see me if you want to chat about venture. but for me is a really kind of interesting, vibrant space, and it's a lot of fun as well being involved in it.
Super, thanks Ben. I'll hand to Alessia next, who's next to me. Tell us about what you're doing.
Great, thank you for the introduction, Hayley. So my name is Alessia. I work with SLM Partners. So SLM is a real asset specialist. So we invest directly in farmland and timberland. We manage $750 million of assets and 300,000 hectares across the United States, Europe, and Australia. And our mission is to scale up regenerative management practices across all the land that we invest in. So we're really picky about who we work with on the ground and how that land is managed, because we want to deliver not just financial returns, but also impact across carbon, soil, and biodiversity.
Super, thank you. And last but not least, Johanna, tell us about what you're doing.
Thank you, Hayley. Johanna Holmström. Hi, everybody. It's great to be here. I'm partner and head of IR at Gårdskapital in Swedish. In English, that is translated to Farmers Capital, and I think that's exactly why we are sitting here today. Gårdskapital is an emerging private debt fund investing debt to farmers in Sweden only right now, but growing and hopefully expanding across the Nordics and Northern Europe.
Super, thank you. I mostly got Johanna to introduce herself because I didn't want to try and speak Swedish. But thank you for that. So we've got Sweden, Somerset, and SLM on stage, which is wonderful. What I'd love to hear from each of you now, you've introduced what you do, but is a bit more about the why. And the why is both why you're doing it, but what is the opportunity within this focus area for you? So there's obviously opportunities across the value chain, opportunities across different types of capital. But maybe we can reverse the order a bit. And Johanna, first, tell us a bit about why this is your focus area and where you're doing that.
Well, for me, if I should do it from my personal perspective, I have been playing in the private debt and the venture capital space for a very long time across Europe and the UK, coming home to Sweden and also having grown up on a self-sufficient farm. So I've dug a lot of potatoes and made a lot of sausages in my childhood. And then coming back and setting up Gårdskapital is something feels like coming full circle for me. And so a huge engagement for me to start working with Matthias on this. And as for the asset class private debt, in Sweden we have something called the Land Acquisition Act. It was passed somewhere in the early 1900s. It means that we can't, as a fund or a company, we can't own farming land. And that was because we wanted to keep our rural areas and keep hold of the family farms and the local produce. And that has, since we actually love that act in Sweden. Norway is the same, Finland and Denmark are different. So private debt is the asset class that we can use to help farmers invest in a sustainable change, for example, or a generation shift that we also see. I'll talk a bit more about that later, but yeah, so that is why our why.
Super, that makes sense, and I think speaks to that sometimes there's an opportunity that you jump on, and sometimes you choose your methods by necessity, not just by what's exciting.
Yep.
So that makes perfect sense. Alessia, why are you focused on this, and I guess why real assets?
Yeah, so I'm actually one of the few people at SLM that doesn't have a specific ag or forestry background, and my background is in impact investing. So in my prior roles, I was doing a lot of research across impact investing in different asset classes, so looking at equities, fixed income, private equity, real estate, and also across different impact themes. And obviously my favorite theme is food and ag and biodiversity. And for that theme specifically, real assets really stands out to me as the way for investors to have the most tangible and direct impact. Because really through real assets, you own the land, and so you can control how that land is being managed. And just to give an example, so we've been investing for a long time now. We started our first investments in Australia back in 2012, 2013, and we acquired a few grassland properties there in southern Queensland. And when we bought the properties, we could completely change how it would manage. So we converted conventional cattle operation into a holistic plant grazing operation. So we implemented the regenerative grazing practices of Alan Savory, and we completely turned the business around. We invested in the infrastructure that we needed for that system with the fencing and the water points, and most importantly, we built the team there to run it that had the knowledge to implement these practices in real life. So yeah, and another thing that I find really unique about real assets compared to other ways that you can invest in the theme is just how much you can measure on the ground. Like, it's really easy to see how your money is impacting change on the land. There's really no limit to what you can measure. It just gets really expensive. Yeah. So you have to choose what you measure. But for example, in Australia, we've had grassland ecologists come on the property since 2014. She's been tracking how vegetation changes over the course of the time that we own and operate the land. And so that's really valuable data that is hard to get in other asset classes. And then from a more sort of financial perspective, we work with a lot of very big institutional investors like pension funds and insurance companies, and they really value real assets as an asset class that brings an incredible diversification to their portfolio. Because the value drivers in this asset class can be quite uncorrelated to broader markets. If you think of a forest, for example, the trees will be growing and creating value no matter what happens in equity markets. So that's something that the big institutions really value. And they also really value the income yield that you can get from real assets. So while you hold the land, you can generate income from the rents or from the production and sale of commodities. Now, it's fair to say that it's only for very patient capital because these are very long-term investments, usually sort of 10+ years structures. Yeah.
Yep, and that's a good point, actually. I mean, everybody we're talking to on stage, when we talk about private markets, we talk about any of these examples, they are longer term than daily liquidity, which you can get through commodity trading, etc. So I think that's worth bearing in mind. And actually, I would love to come back in a little bit to the measurement point, because I think there's a lot around that. But Ben, tell us why are you focusing on what you're focusing on? What's the opportunity there?
I think I'll go personal as well. So every single day we wake up, we have an impact, and we need to decide what we do with that impact. And we can have a bad impact, or we can have a good impact. And I've just got absolutely fed up of watching the modern food system literally kill us as a human species and the planet that we live on and we call home. So I just can no longer kind of watch and see this happen. So I've found myself in a very lucky, privileged position to be able to deploy capital into a space that's really super exciting and actually hopefully is creating a difference, because that's the kind of legacy that I personally want to leave behind, and try and use my personal energy and the knowledge that I have, a little bit of the knowledge I have, of trying to do the right thing. And I think that's why we're all here in this room today. But we exist in an echo chamber, so what we're trying to do is really scale that impact. So the modern industrialized food system is absolutely colossal. And on the stage, we just form one little part of a change that needs to happen, bring in private capital to bear to back the highly passionate founders who are hopefully going to change the world tomorrow for everyone sitting here today. So it's a bit of a personal mission for me. I feel very passionate and emotive, and probably start swearing at some point about all the issues. So I won't go down that road. You can catch me at lunch and we can swear together at stuff. We seek out the high growth, high impact, but high risk sort of venture growth equity opportunities. As the sort of slide shows, we invest across the agri-food supply chain. Is it across or up and down? I never know. And we seek out tech that might help farmers on farm with measuring their impact. A good example would be carbon, but just one example. Through to the processes, and we heard a great session earlier about some of the changes that need to happen within processing. Roughly 60% of what the UK eats as an adult is now ultra-processed food. It's essentially a kind of a calorie-led substance that has almost no nutrient density whatsoever. So that is one of the reasons why we're seeing such massive chronic health issues, particularly in the UK, but also in Europe. And then finally, perhaps slightly distinctly for a VC in this space, is we look at branded consumer FMCG as well. So downstream, because we need to create the demand pull through. So a great example of that for us would be Wild Farms is one of our investments. So we've loved supporting the guys and watching them grow very rapidly, which is great from a pure investment perspective. But they are trying to change the system, and it's blooming hard work, and it needs a lot of capital.
Yeah, that makes sense. And I think an interesting note on the pull from the consumer side, there's been a lot of discussion about regenerative agriculture specifically and the farmer lens, which is, of course, the anchor to everything in this. But ultimately, somebody is eating this food in the same way that we're drinking the coffee that comes from Brazil. So
Exactly.
Worth understanding where the push and pull factors come from. Within all of that, all this opportunity, those with investor hats on can look at a lot of diversification within these different strategies. There's also risks that are attached to each of these, and those risks are very nuanced, idiosyncratic, asset class dependent, but often dependent on geography, weather, crop type, etc. Maybe we can dig into the risks that each of you deal with daily and kind of what's top of mind for you. And I'm going to reverse that right back to you, Ben. So you've talked about the thumbs up. What are the possible thumbs down?
I mean, multiple risks out there for every single company that we look at. I'd say, obviously, on the kind of the tech side, there's tech risk around what a company is trying to do. Often we'll be looking at businesses that are very early stage, hopefully generating revenue, but still the technology will be probably still being developed, still being worked on, with the use cases starting to sort of coalesce with kind of commercial traction coming through. So tech risk is there, and then into kind of scaling of that solution often is a problem. Teams need to grow very rapidly. That comes with its own challenges. Any founder in the room will know that bringing a team together is probably one of the most critical skills that they will have and need to have in the future. Financing risk, clearly a lot of the businesses we look at are burning cash at a healthy rate of knots. So that there is a critical risk in the future for most of those businesses in seeking finance as they move through the kind of the capital stack. So I think founders will often underplay and perhaps not realize quite how long that will take to raise funding, particularly in the current market. 6 to 12 months is probably a good kind of measure there. And then finally, kind of scaling, we need the customers and the pull through for either the brands or the techs need to be taken up by larger companies, and that just comes down to a use case, which is often the kind of the critical assessment for us is are people actually going to buy this tech?
So you made a good point when we spoke previously about the commercial case now being much more important than maybe it was a couple of years ago, and just the narrative around the impact isn't always a positive attribute anymore, but maybe you can just expand on that.
Well, I mean, we all read the papers and have just got our heads in our hands about the administration in the US and the kind of the rolling back of net zero and coming out of Paris, etc. And then closer to home, across Europe, we're seeing sort of a political move to the right, probably in a couple of countries, and even in the UK, we've got what would potentially be called a centre-left government, but they're rolling back on a lot of the kind of environmental protections in the UK. So we're seeing this quite troubling rolling back of kind of a policy level, some of the things that previously would have been drivers for us. So we just can't rely on regulatory drivers at the moment. So for example, for us, we would never bake into an investment model carbon credits as a potential revenue stream. Nice to have, but you cannot rely on that. So it's just becoming more important to have that use case where just a regular company will buy that because of it was saving money or be generating a yield play or something like that. So
yeah, makes sense. I keep quoting Churchill, but he also said never waste a good crisis. And actually, there is a bit of a pivot happening in how we talk about these things and which parts of business models investors are focusing on. Johanna, maybe when we spoke about this previously and about risk, you also talked about the importance of due diligence because of the risks that you're having to underwrite as a direct lender. Maybe you can expand on that.
Yeah, so we obviously work with people and in many cases families, naturally. So we have a credit scoring that we go through together with our IC. And there are factors like business acumen. What does the figures look like going back? What are they using the proceeds for? Can we measure that in increased revenue over time? And that is a big value driver. It's to increase the farmers' revenue over time through, it can be energy efficiency, for example. It can also be different practices, different ways of growing. It can be increasing land through leasing more land, for example. So we look at all of those factors. And then we also work extremely close with our farmers. We go out and visit. We are a phone call away in order to be there ahead of the game should something happen. We can also actually de-risk our model with credit guarantees from Europe, which is fantastic for our investors, for sure, but also protecting our portfolio. In Sweden, for example, there were a lot of, as the world is going where it's going, there were a lot of insolvencies in early stage tech, sorry, Ben, but 0.05% of that was actually a farming company. So they are, you guys are amazing to drive change and drive our supply chains for food. That's the only way we can actually eat and not having to eat those processed foods, which is very bad for us indeed.
Yeah, and I think speaks to the depth of due diligence you're able to do with that local regional focus and understanding the ecosystem very well that you're operating in.
Exactly, and then we also have an ESG framework for our farmers in order to measure certain steps they are taking to becoming more sustainable, for example. And as we have 3 climate zones in Sweden, it's a very long country. It's certainly different in the south from the north, for example, what we can measure and how that looks. So it's case by case and region by region.
Yeah,
and
absolutely.
Working with local advisors on in those regions as well.
Yeah, absolutely.
In order to safeguard our model.
No, that makes sense. Alessia, you're also investing in farmers, farms, crops in the ground. That's at risk of weather and climate. What else are you looking at, especially when you think about due diligence of these potential investments?
Yeah, definitely the physical risk is there as land investors. We have to think about the climate risk, the water risk, the soil degradation risks, etc. We have to think about that across every step of the investment process. And so it's really important that we take a few steps. So the first thing that we do really carefully is make sure that we diversify the portfolio as much as possible across different properties, across different microclimates, different watersheds, and different operators, just to sort of spread that risk a bit. And then the second point to what you were saying is the due diligence. So we do a lot of work prior to acquisition to understand the fair value of the land by researching and understanding what's underneath, the soil quality, the land rights, the water rights, the access to markets, the expertise and the capability of the local operator that we're going to be working with on the ground. That's really important. In the past few years, we've been doing a lot of investments in Iberia and California, so water and irrigation has been something that we have to spend a lot of time on, and I see that there's Lobelia in the room. We've worked with them on some water due diligence. So that's a lot, but there's also a lot that has to happen after acquisition, because we think about risk also as something that we need to tackle through the management practices that we implement on the ground. That's sort of the objective of these regenerative practices that we're implementing, is to build a more resilient business model, ultimately. And actually, the grassland properties in Australia are a great example of that, because thanks to the regenerative grazing management practices that we put in place, we were able to set up carbon projects on these farms. And so we diversified the revenue streams. We were not just with the cattle revenue, but also the carbon credits, and we sold over 1.7 million carbon credits in the regulated Australian carbon markets there. And that was really valuable, not just as a cherry on top, but when the drought hit and the cattle revenues were down, we had the carbon revenues there. So it really helped build resilience.
Yep, that makes sense. And actually, I think due diligence is one thing, post-investment is another thing, and that actually takes us into thinking about this very tedious word, which is measurement. We want to know what success looks like, what outcomes are we measuring for, and these three on stage have the responsibility of sitting between their investments and the investors in their various funds and saying all these good things happened and we measured them and we promise we measured it and it's good. So maybe we can talk a bit about that. And Alessia, I think you've got some good examples, and I guess your due diligence plays into this. It's not just for a nice investor report at the end of everything. It's actually integral data to how you think about your underlying assets.
Yeah, absolutely. And all of our strategies are rooted in a theory of change. So we elaborate on these in our impact report, and we make each theory of change very context dependent. You know, we have one for row crops in America, one for permanent crops, for grasslands. And so it means that every time we're implementing a strategy, there's a transformation that we want to see happening on the ground. And we can translate this transformation into more quantifiable KPIs that we're tracking. And one of the important things that we do is every time we set up a strategy and we start investing, we set ourselves a target. They're not perfect, but we go for something simple that's easy to measure and easy for investors to understand. For example, in our Iberian orchard strategy, we're targeting to have at least 50% of the land certified organic by the end of the fund. So that's an easy target. But it's more than just a target for us. It's also something that we measure success, and our own performance fees are tied to that. So we only get paid our performance fee if we deliver on the financial returns and on these impact targets, the organic certification being one of them. And then on top of that, there's a lot of measurement and monitoring that happens to understand how the transition is playing out across the properties. And so we do a lot of work to collect as much information as possible on the ground, working with the operators, and we do this sort of the bulk of it on an annual basis. And we will leverage experts when we need them, biologists, carbon experts, region ag consultants, to provide as much transparency as possible to our LPs. And in the impact reports that we have for the strategies, LPs can see detail on the results of the soil analysis, on the water that was used on the properties, the inputs used. You know, they can go in as much detail as they can or have time for. Yeah.
And I think this is a real value out of where private investment managers get involved in some of these things, because the average farm doesn't have the capacity to process that data, even if it's being captured, and actually draw some conclusions out of it. So I think that's really, really helpful. Ben, in Venture World, what does success look like, and how are you capturing some of what we'd call impact metrics?
Yeah, so for us, the food system sits at the intersection of the climate crises, the human health crises, and the natural capital or biodiversity crises, to name just three mega topics. And so focusing on one particular metric is dangerous. I mean, that's arguably why we're here now, because of the focus on yield over everything else. So for us, we created a thesis-driven, kind of thematic investment strategy that pinpoints areas of intervention within the food system that we want to back and to invest in. And there'll often be certain key drivers of impact within that part of the value chain. So we don't focus on one particular measurement. We have a kind of a suite of measurements that we've developed internally over years, actually. It's taken a long time. And that asks various different questions and for various different pieces of information. And, you know, at the start of the journey with us, those businesses probably won't have all the answers. In fact, usually don't. They don't have the resources to be able to bring some of it to bear, as we've heard. And that's part of our investment thesis, is that we're creating that journey, creating a better impact as we go. And it is important for us to measure different things. It seems a bit flippant to say we can't focus on one particular thing. We focus on numerous different things, and that gives us almost like a balanced scorecard type appraisal of those businesses, and we'll then work really closely with the founders and the management teams to try and understand their impact in more detail to start reporting on it. So there's no one particular thing for us. It's a kind of a sort of a moving feast of different information that we look to in order to avoid those unintended consequences of focusing on one. Quite easy to focus on carbon, but all of a sudden we're killing people through ultra-processed food, for example. So, that's not necessarily a great outcome. So, it's a mixed bag.
And Ben, just to expand on that, I know within the real assets, or talking about actual farms in actual places, the context piece is a bit more obvious. But in what you're looking at, where does local context play into the venture mindset? And you've just mentioned a few things that you're measuring, but is local context as important, or not really?
Context is everything, because what we're trying to do is create systemic change. So we're wanting those companies, those founders, to create impacts that have a wider role within a food system, but it starts at a local level, because they'll be hopefully drawing from an organic supply chain or regenerative agriculture supply chain. They'll hopefully be working within that locality, because that context and that impact is critical. It's only through that kind of layered approach will they then start to have a wider impact. So it's starting at the local. It's really important. Our food system is different to the US's food system, as an example. There'll be different challenges there.
Yeah, no, that makes sense. Johanna, maybe you can answer the same question on impact measurement. What are you measuring for? What does success look like? But built into that also, where is context important, and why is what you're measuring different to what a bank might be measuring?
Why, exactly. Well, one, if you look at the fund measurements, obviously that is no defaults, or as less defaults as possible. We can do that by working that close to our farmers, for example. For the impact that we can measure, obviously it's we're looking at the revenue. Farmers must be able to increase their revenue by making investments. And those investments we can measure for increased land, for example, through regenerative farming. We are working together with a carbon credit company, Agronom, for example, that we are pushing that out to the farmers. And that will be an easy measurement for us to measure actual acres. That is changing. In Sweden as well, we have a lot of public data, so the farmers actually need to report to government agencies for soil health, for example, what they grow, all of those kind of yearly things that they need to report, and it's public, so they don't need to report to us again. So they don't need to do things twice, which is good. They need to spend time on the farmland. Other things as well, we are also working together with the banks on the generation shift. I'm guessing this is not just up in the north. We have this problem across Europe. It's hard because the value of land has gone up, and it's very difficult to buy that, for example, as a family, or you are 3 siblings, one wants to go to Australia and beach bum, and the other one wants to study at Harvard, and the third one wants to take over the farm. But the farm is worth 5 million euros. That's very difficult to fund when you're 23 years old, obviously. And the bank can lend 60%. That is the laws and regulations for lending here in Europe. We can go in and help together with the bank sort out other capital out. And that is also something that we can actually measure then. We have a lot of acreage that needs to change generation in the Nordics right now. The Swedish farmer, half of them are over 60, 65, and they have worked for all of those years on the land. So that is also in the future that we will be able to measure that change.
Yep, I think that generational shift is something that everybody's dealing with in different ways.
Absolutely, and we need to get the young farmers out there, definitely. And we also see that that generation, they are more apt to making sustainable changes and smart choices and regenerative, for example, onto the farm.
Yeah, no, it makes sense. My dad at the age of 80 is still farming from sunrise to sunset, and I promise you, he doesn't like change. We've got some time for a few audience questions. My first question to you all quickly is, who is not looking at their phone right now? Fantastic. Right, so questions from you all. We can probably take 2 or 3.
Hayley, I have some that came in through online, so
Okay.
we'll get this one up front
Okay,
after.
we'll start up front.
I'll do one first.
Okay,
while he
you
gets the
start
mic,
and then we'll come up front.
Is the climate resilience risk reduction aspects of the transition to regenerative agriculture well understood by investors, particularly in terms of reducing the cost of capital and returns expectations for regenerative ag projects?
Do you hear that?
That's
So
a mouthful.
Sort of. Yeah.
Okay, so I think the question was about the risk reduction benefits of focusing on elements of climate and if that affects the cost of capital or not. Anyone want to jump in?
Yeah, I mean, for us right now, we're not including it in the modeling per se. So as I said, but we are managing the risk through diversification and by getting as much information as possible, by using climate models, etc., to factor that in yield expectations. So in a way, it is in the model, but it's not necessarily, we're not including the beneficial impact of regenerative agriculture in helping climate resilience, but we do see it there and play out. But for now, we're focusing more on the more economical ways that the regen practices can deliver resilience, like the carbon revenues, the diversifying revenue streams.
Yeah, makes sense. Either of you want to add on that?
Yeah, I mean, I think the question was, do we understand the risks? And we talk about it absolutely every hour of every day. If you came to work at Yo Ventures, you might get a little bit bored of us talking about it because it's literally all we talk about. We understand it deeply, and it's a risk, but it's an opportunity as well. That's one of the exciting things about regenerative agriculture is it is creating a resilience to those climatic changes that are happening, whether we like them or not. We are possibly beyond that tipping point of 1.5 degrees, unfortunately. And so we're into a world of having to respond to those things. So it's as much of an opportunity as it is as a risk. So a good example of one of our investments, MegaCrop, helps farmers with live information of how to direct their herds around their landscape. And why is that important? Because very simply, they're trying to reduce the level of bought-in feed from ghost farming. And ideally, farms are becoming more resilient by using all of the resources that they have within their farm boundaries. So it's just one example of a real opportunity rather than, there's risk, but it's actually, we look at it the other way around, I'd say.
Yeah, great. Johanna, I'm going to hold you on your answer. Let's take this question and let's see what it is before we carry on.
Yeah, thank you, Johan Hoff. I want to come back to what all of you mentioned in some way, which is the question of measurements. You need to measure the progress. I'm now less talking about the impact, like 50% certified organic, that's simple, but the underlying biodiversity, carbon, soil quality. And especially if you want to measure this for a global portfolio from California to Australia to Iberia, you work with a globally active consultant? Probably not, right? So how do you, Alessia, I'm looking at you because you made most of the mention of it, but I think Johanna mentioned it too. How do you then, ensure the quality of these measurements that you ultimately pass on to your LPs, right? Across such a diverse set of landscapes. So is there a way to make this a global standard in measurements? Do you have offers for that? Or do you basically have a bunch of Excels and then need to work with that?
Yeah, I think what's really difficult is that we want something simple that we can sort of, a metric that we can aggregate across all the things that we do, but then it becomes a very high level metric. And that's what we have to do on biodiversity, for example. To be able to report biodiversity at a firm level or even at a strategy level, we have to focus on simple hectare-based metrics like amount of hectares that we set aside for biodiversity, amount of hectares where we have a high conservation value habitat. But the real benefit of what we're bringing on the ground is not just on the land set aside, it's on the farmland and what's changing there. And the reality is that for now, the way we track this is too specific for it to be a high-level metric. So we offer that data at the strategy level to our LPs who invest directly in just orchards in Iberia, for example. And those are the types of metrics that are specific to that ecosystem that we get from local biologists that work with us on those farms. But it's hard for us to aggregate that and report something at the firm level. Yeah. Yeah.
I think that, and it maybe links to my final question to the panel, but we're also looking for synergies between these different types of capital, and where some of Ben's potential investments come in are in the technologies that are able to start measuring some of these things. And incidentally, I actually looked yesterday, and PitchBook now has a soil health landscape. I mean, you wouldn't think PitchBook would ever use the word soil, but it's a landscape of technology starting to look at how you measure and quantify positive attributes in soil. So that if that's not a positive tailwind, I don't know what is. I'd like to end on a final question which speaks to the synergy and how we get all these types of capital working together. But to each of you, what is really needed in this space? Is it more of what you're doing? Is it more of what everybody else is doing? Is it just more capital? And I guess if you had a magic wand, what would you point it to say, I'd like this thing to grow? Johanna, you want to start?
Yeah, sure. It's a blended capital injection, for sure. I think all three of us sitting here are equally important for different countries, regions. We have different laws and regulations, obviously, to what we can do, and to be fair and see how can we work together in Europe to actually invest in agriculture and in the land, and as Anouk said earlier today, in life, because I think that's what we all are. We are all doing that, and all three of us equally important. And capital to farmers it must be number one on Europe's agenda as we see what's going on in the world around us.
Right, so capital in Europe, working together,
Yes.
blended options.
Yes.
Ben? What
She said. Yeah, we need more capital. I guess I'd sort of class myself very similar to how Anouk described herself as being, ultra competitive. And we need competition within the capital provision. We need competition for that capital. We exist in a current system where we need growth coming from venture into the different asset classes. I think if there is a hole at the moment, it's probably sat above venture. There is capital out there in that space. I think what we're not yet seeing is some of the growth into the Series B, Series C, Series D, that kind of level of, I guess, what would be private equity type buyouts. I think the model is challenging there at the moment because impact sometimes loses its way with a more ruthless focus on profit.
Yeah.
So that, I think, is possibly the gap, but just generally more capital because we need it to grow our impact.
Yeah, and the growth equity often gets called the missing middle, right? Yesterday we were referring to the missing midstream, which is a different thing, but more on that later. Alessia?
Yeah, I guess on the positive side, we're seeing more and more investors sort of create new allocations to real assets, because for a lot of them, they didn't necessarily have a real asset allocation before, and they need to create it. So it takes time, but it's getting there. But definitely room for more, and specifically in Europe, if we could get more capital flowing in Europe.
Absolutely. I think SLM's been beating that drum for a long time, often alone. But there are more out there. I have a final question to all of you in the audience. Who thinks they learnt something from that panel today? Hands up. Okay, well then we've done a good job. Thank you so much to this wonderful team on stage, and thank you all.
Thank you for moderating.
Well done.